Hi everyone, and welcome to the bi-weekly EcoInvestment update for November 22nd, 2015. And you know what, guys? The market just keeps cruising higher and higher, and we're coming really close to the point where we're going to have a big determination whether we're in the biggest suckers rally since, I don't know when, maybe April of 1930. Or whether we're going to go scooting on to a new high, reconfirm our original thesis that rising interest rates are the only thing that can kill a bull market, and then all bets are off as to how far and how to what crazy heights we can go. Every market at the end stage, assuming that we have just gone through a major correction at 18,300 to 15,600, let's call it, about a 3,000 point move. Let's assume for the sake of argument that was just a big correction, and it was a big one and it was a scary one. And but if it all turns out that it was in fact just a correction and not the beginning of a long-term bear market, then we have to come to the realization that what comes next could be unprecedented in our lifetimes here. And that's a market that, well, instead of having meltdowns, which you've always come to know as a term that's often associated with the stock market, we could have something called a melt up, where there's just no stopping the market short of rising interest rates and several rounds of rising interest rates. So what's it going to take to reassert that original thesis that interest rates are the driver of the market? Well, number one, we know through history that typically what stops a bull market, any bull market, from rising is that the source of funding gets pinched off. It can be anything from as simple as, well, when gold and silver were soaring in 1979-80, and everybody and his mother were jumping into the gold market and the commodities, the COMEX, the Commodity Exchange of New York, to buy gold contracts and silver contracts. And the Hunt brothers tried to put a corner on silver in 1979, 1980. You know what the Commodity Futures Trading Commission did and the federal government did? They stepped in and raised the margin requirement, or the amount of money that you had to put down to open a fresh position. And I guess what happened, it just totally put a knife in the market, because the rules of the game had suddenly changed. What worked until the day before they put that rule into force did not work anymore when the rule went into force. It's the same thing that pinches most bull markets, and that's, there comes a point where there's so much credit and so much attention and so much risk being rolled into a bull market that steps are taken, sometimes from the outside, to create an event that's going to pop that bubble. And in most cases throughout history, that's been rising interest rates. And the sad reality of it is that we live in a world that's very fragile right now. And if we do have this runaway bull market, which is entirely possible, and I'm not saying it's a reality yet. I'm saying don't jump the gun here. You could really end up being screwed. But if we do have it, this runaway bull market, then it's going to take a lot to bring it down. And that by the end of it, when all is said and done, there's going to be a tremendous amount of pain on an economy that's already pretty well fitted up with its fair share of pain. Not only on the employment front, we can talk about 5% full employment, but you and I know very well, employment today is not what employment was 30 years ago. By no way, shape, or form is it even comparable to what it was then. So stay tuned, guys. Now, the other side is, if this turns out that, as I said, most bull markets fail on the rally, not the initial fall. In other words, when a market does a huge drop like the Dow did from 18,300, 400 to 15,600 or whatever, That's a real big fall. It scares a lot of people. But students of history and traders know, and investors know, savvy investors know, that after you have a big fall, especially after an extended rise, the market's going to do everything in its power to have one last hurrah to try to recapture the glory of that old peak. And that's the kind of situation we could be in now. We could come up 300 points, 400 points short of the old all-time high. We could come up 50 points short. We could come up 1 point short. We could go up and make what's called a nominal or just tiny intraday new high and then turn around and be dropping like a stone. We've got to be very careful here. In other words, that first move that took place in September that was so scary could be the opening bell preview of coming attractions to what's ahead of us. So we want to be careful that we're not rushing in buying at the very worst time when the market's already had a dramatic attempt at a new bull market high. Hey, there'll be tons of money. I got at it about 17,300, and you know, you can temporarily feel like a genius because you drop down to 15,600 or whatever. I knew the market was going to take a dive. I also knew the market was going to attempt to make a rally. So even though I've been out of the market, I'm in no rush to get back in again, because if we do make a new all-time high, then it's going to signal the all clear again. The old theory about rising interest rates being the only thing that can kill a bull market will be totally back in force. In other words, our original thesis will be re-put into place again, and Lord knows this time we kind of know going forward the news from outside isn't going to kill the market. It's going to have to be something like rising interest rates. And if that's the case, we could go thousands and thousands and thousands of points till stocks become not just overpriced, but ridiculously overpriced. If you've looked at the chart of big famous bull markets in history, the bull market in stocks in the 1920s, the gold market rise of 1979, 80, soybeans in the mid 1990s. I can think of 100 orange juice, cocoa. I can think of 100 things. Palladium, when fusion was talked about. I can think about 100 markets that had these big spectacular moves. And you know what? They all had a chart that sort of rose like this, and then the longer and older the bull market went, the more up and down and almost vertical these charts went, until you were almost in this straight up, you were in this parabolic, like straight up market. And as Napoleon famously once said, you can do anything with a bayonet except sit on it, and you can't stay up there for long. But it could be a hell of a ride, guys. Anyway, stay tuned, and happy Thanksgiving to everyone in the USA. We're going to be patient. We're not going to front run any market here. We're going to let it do its thing. Big deal. We get to jump in after having lost, opportunity cost of 600 points or so. I'll take that. Any day of the week for the surety that I'm not going to go down on an elevator that the cable's been cut. All right, guys, stay tuned. This market is born to excite, and I am sure it will. Have a good one, everybody. See you in 2 weeks.